Good morning. Thanks everyone for coming. As I mentioned earlier, I'm going to be speed talking because I have about 30 slides to do in 20 minutes. So for those of you that might still be doing 1031s in spite of the Opportunity Zone, this should be some very good information because it's post-Tax Cut and Jobs Act. A little bit about who I am. The fact that we are owned by Stewart Title, a 125-year-old publicly traded company, is very critical to anyone doing a 1031 exchange. Does anybody know why?
Qualified intermediary.
Yeah, what do we hold?
Money.
Money. So you want to know, and you would prefer to have the written backing of a large creditworthy company backing your money and everything that we do. So that's why I talk a little bit about our parent company. Let's talk a little bit about the code sections and what's changed. Well, Section 1031, prior to the Tax Cut and Jobs Act, was applicable to any kind of personal or real property. That has changed after the Act. As James said earlier, it's real property to real property now. So if you're selling a hotel and there's furniture and fixture and you're giving that furniture and fixture some value, you've got to be careful because you can have a taxable tax consequence on the sale of the personal property. Now, some take the position maybe there's no profit, no gain, no value to be attributed to the furniture, but this is something that you have to have analyzed by your CPA and your legal advisors. So you don't step into a situation where you inadvertently have tax boots and you can't defer it because 1031 exchange no longer applies to personal property. The slide also shows the other code provisions that are applicable to the sale of real estate. I think we're all pretty familiar with Section 121, the sale of your primary residence. We happen to do a lot of 1031s with property that at one time was a primary residence. And the reason in this area that occurs is because you can only still exempt $250 or $500 of gain on the sale of that primary. And many times our investors end up with a lot more gain than that. So they'll convert the primary to investment property, do a 1031 after a couple of years, and still get the benefit of their exemption because 2 of the last 5 years the property was primary. 1033 is involuntary conversion, so you get money from insurance or insurance proceeds or condemnation, and there's a deferral mechanism there. You don't need a QI. And 452 is seller financing, where you sell property and you take a note back. My screen is not up, that's why I'm leaning over to see. It's gone off here. James, there was a little piece of paper. Can you call the... It's gone here. Did you take it from here? His number?
Oh, you're back. Okay,
Okay.
good.
Yeah,
Don't go back to the last slide. Go ahead.
Right, exactly.
Okay,
Okay.
all right, good.
All right, this is just better. I'll stand. Okay, so capital gain taxes, and this is an important note to make. Everybody thinks after the Tax Cut and Jobs Act that we have a reduction in taxes, not for capital gain taxes. People are stunned to find out that today we still will end up paying 35% on the sale of appreciated real estate when we take into account federal, state, and local taxes. And the summary is on your slide there. I won't go through it again because I'm trying to be efficient time-wise. But anybody who wants the slide presentation, I'm happy to email it after the presentation. Okay, Opportunity Zone versus 1031. James highlighted the most significant part of the difference, which is Opportunity Zone, any gain from any sale of any asset. You can put the money into an Opportunity Fund. 1031, real property, and real property. No time restrictions on the property that you are putting into the 1031 as long as it was held for investment. And that is a concept that many don't grasp quickly. It can't be property primarily held for resale. It has to be investment property. Tax deferral, infinite. Okay, we can keep swapping properties, doing 1031 exchanges forever and ever, as long again as each property independently is held for investment. And it can be anywhere in the U.S. Okay, we're not limited to a distressed area. Both of these provisions, the investment has to be made within 180 days of the sale date. So you're in the same window. Now some folks doing a 1031 are asking, well, Pamela, if my 1031 fails, can I go into an opportunity fund? Yes and no. If you don't identify in the 45 days, and then your exchange will collapse on the 46th day. If you get your money back, you have time. There's still remaining days to go put your funds into an opportunity zone. If you identify property and you don't actually close on everything within the 180, and you have leftover gain that's not subject to deferral, so you would have boot. Your problem is you're out of time. You've just lost your 180. So those that are in that window can actually still defer the gain because you don't have to use the same funds. So if I had in James's situation, $10 million I was supposed to spend, and I only spent 9, and I'm at day 179. So I've got $1 million left over, a gain I need to spend. If you have that million sitting elsewhere, you don't need it to get it from the QI, because we are prevented from giving the monies to you before the 181st day under most circumstances by something called the G6 restrictions. You can get the $1 million elsewhere and put it in and still defer the gain on that million if you are liquid and have that fund elsewhere. So you can actually use both statutes together, although you really have to be clear on your strategy. And of course, 1031 is not a 15% step up in basis. It's 100 as long as, again, you did what you needed to do to 100% defer your tax, which was basically, if you sell for 20, you've got to reinvest 20, including any debt that you paid off. Okay, so as I mentioned earlier, real property, this is section 1031 of the code as it existed in 1921. The only change by the Tax Cut and Jobs Act is that it's now only applicable to real property. We still have exceptions that we cannot perform property other than personal property that will not suffice or will not qualify for 1031. And the primary exception is any property you bought primarily for sale, that means flip. Any flipping properties aren't going to qualify. You need to hold them 2 years, 1 or 2 years for investment. So that means not listing it for resale with James, okay to list it for lease with James, not for resale, because that is resale activity. And very importantly, partnership interests. First of all, they're personal property. So all of you that own properties and multi-member LLCs, that's everyone in this room probably, your membership interests, you can't sell them separate from the LLC and do a 1031 without restructuring. And that discussion about how you restructure when you hold properties in a partnership will take the rest of the day. So we're not going to have that discussion today, although I will give you a few examples of what can be done. What I can tell you is whenever you own assets with multiple investors and you may be getting ready to sell the property, you should begin talking to your legal and tax advisors very early about if you need to restructure, how you restructure ownership to allow the individual investors to independently 1031. The partnership or the LLC can 1031 all day long because they've owned the property for many years. But when we take out the, sorry, I got ahead of myself. When we take out the individuals from the LLC and want to take, we've got 3 brothers owning the property, and they're selling for $30 million. They all have $10 million coming to them. And each brother wants to take $10 million and go to a 1031 on their own. They can't do that as they are currently structured because the partnership or LLC is the entity that has owned the property for investment all of these years. And I've skipped a couple slides I'm going to go back to, but basically you have to have investment intent, which means long-term ownership of a property without resale activity during the investment period. And those are the factors that the IRS will consider on the screen, determining if you have qualified. Okay, so people ask about the holding period. How long do I have to own it? That's the number one question I still get today. The code doesn't provide any particular period. The conservative view, and it's a view by most authorities, is 2 years without resale activity. In other words, without listing it with James during that time for sale. And the liberal is 1 year. Anything shy of a year, I mean, people are getting pie-in-the-sky numbers for short-term holds today, and if you're in an opportunity zone, you're going to be one of those investors likely. That's very risky. Anything less than a year, they'll disqualify you for failure to hold with investment intent. So you have to be very careful. Lots more on that for another day. Another provision of 1031 is the same person or entity has to buy and sell That doesn't mean the same person or entity has to be on the deed. It means the person or entity that's filed the tax returns for the property being sold needs to be the same person or entity filing the tax returns for what's being purchased. Okay, there's a legal distinction between deed ownership and tax ownership for the purposes of 1031. But basically speaking, we've got a wife selling, a wife has to buy, partnership selling, partnership purchasing. Okay, and then let's talk about the partnership issues. So traditionally, we've had, anybody heard of a drop and swap? So that's the traditional method of restructuring our partnerships so that their individual owners can go ahead and do a 1031. What that is conversion of the LLC to what's called tenants in common. So there's a transfer of ownership from the LLC to the individual investors. Now the LLC is no longer on the deed, the individual investors are. All kinds of issues with this. Loan violation of the loan covenants, if there's a loan on the property. If you've got debt-free property, this is much easier. We see clients not doing this till closing, and that's highly risky. Does anyone know why it's risky to do a drop-down right before closing? So we convert the three brothers that own the property to individual ownership. Maybe they form 3 single-member LLCs and each own a third of the property. They do that after contract and before closing. So what happens? Well, we've only owned as individuals as what we know of as tenants in common for a short period of time. Do the tenants in common qualify on their own for 1031 treatment? And that's a big issue. We have no clarification in any place in the Northeast on this issue. So the safer way would have been to do the drop down long before any contract was signed. But that's the perfect world, and we don't have a perfect world. So the legal and tax advisors will carve up solutions. If you've already signed a contract, dropping it down is not necessarily disqualifying, but you have a risk. You have to be able to recognize the risk. You also have a position to take in your favor, which is that you can tack on the ownership period of your partnership interest to your tenants in common to establish long-term investment intent and therefore qualify. But that's just a position. There's no law to that effect. So we're a little bit in the gray area where we don't like to be. Another solution is to just keep the property as a partnership, do your exchange, buy a $30 million property, and after you've owned it for 2 years as a partnership, then drop one third of the building down to each of the brothers. That's clean. That's pretty risk-free. I'm just throwing out concepts here without getting into too much detail on what you can do. There's a great solution called a partnership installment note for those of you that are in partnerships, and maybe most of the people or many of the partners want to stay together and do a 1031, but there's some that want to liquidate. And typically, if you're selling for $10 million and you use $2 million to liquidate exiting partners, that $2 million is boot to the entire partnership, which is not a good thing. That's not what the goal was. We only wanted the partners exiting to be taxed on the $2 million. Well, this partnership installment note structure allows that to happen. And again, it's too much detail for this presentation, but just put in your head, if you've got that situation where you want to do really a partial exchange because you don't want to spend the whole $10 million on replacement property, but you want to take 2 and use it for exiting partners to redeem their interest, there is a structure, if you come to me early enough, we can put into place to allow only the exiting partners to be taxed on the $2 million. Like-kind property, investment property. Anywhere in the U.S., doesn't matter if it's commercial, industrial, vacant, income producing, doesn't matter, wide open. Non-U.S. property does not qualify under the safe harbor. You can trade foreign to foreign under the authority that's out there, but it's not a safe harbor. You cannot do foreign to U.S. or U.S. to foreign. No. Okay, not even Puerto Rico. So I don't want to belabor the exchange requirements too much, but the second requirement, the first was investment intent. The second is, unlike the opportunity zone, that whole $5 million, less only that $3 million, which is $300,000, exchange expense, needs to go into replacement of property within 180 days to 100% deferred. So it's not just your profit. It's the whole $5 million. And if you had debt you're paying off, I'm not going to go slide by slide, but if you had debt that you're paying off, you pay that off on the sale. you either need to get new financing equal to that debt on the replacement property, or you can reach in your pocket, and if you didn't want to get new debt, you could make up the debt shortfall with cash from your pocket. So you could purchase with all cash. In this example, there was debt taken out to match the debt. There was still some boot because they fell short. $1.7 million. So that's your exchange equation. Highlights to remember: you've got to invest everything if you want full deferral. And if you had debt, you pay it off on the sale. You need to replace it with cash or more debt, new debt on the replacement property. If you don't meet those requirements, you're going to have a little tax to pay on the shortfall, but it's not the end of the world. Okay, so in my a couple minutes left, a delayed exchange, we've been talking about this 180. You've got 45 days to identify, 180 to close. The 45 and the 180 run at the same time period. Okay, so it's 45 plus 135 in order to complete your exchange. The QI in a forward regular exchange, we hold only the dollars, the funds from the sale, the equity. Okay, we don't hold real property. When do we hold real property in a 1031 exchange? Reverse exchanges. When we purchase before we've sold. When we close on the purchase first, then we have to talk about structuring. And the reverse exchanges require the intermediary to actually take title to what's being sold or what's being purchased. Very complicated, again, beyond our discussion today, but keep in mind, exchanges can take a couple formats. The forward exchange, which is what probably everybody in the room is familiar with, where you need to identify all replacement property within 45 days, close within 180, and you have to follow one of these rules in the identification process. 3 properties is fine. You want to list more than 3 properties, you can. But the aggregate value of what's on your list can't be more than 2 times what you sold for. So if you sold for $10 million and you list 5 properties, you're going to be making sure that those 5 properties' fair market value does not exceed $20 million to make sure your ID is sufficient. Okay, so you have to be careful. If you're listing only 3, you can have $1 billion worth of property. 1, 2, or 3 properties, no problem. So here's my final little piece on 1031 exchanges. We have other formats we can use for a 1031. The forward exchange is what most people are familiar with. As I mentioned, if you need to close or want to close, and mainly my REIT clients and my portfolio companies, they close first on replacement property all the time because this is a seller's market, so the buyer's scrambling, okay, to get property that they like. So buyers like to close first. 1031 clients that are large portfolio owners like to close first on the replacement property, which is feasible. You've got to start earlier. There's more complexity, more structuring we need to do. I'll spend more time with you on those issues, but you can close first. And then you must sell your relinquished property within 180 calendar days of the purchase. And we can either take title on your behalf to what's being sold or purchased, and which we take title to is a long discussion, and why we take title to one or the other. But the intermediary parks the property, we net lease it back to you. So no one, from your operating standpoint and from the world looking in, they don't know we're even in the deal, okay? It's just a tax code mechanism. It's a means to an end. And finally, and this is going to be something that I want to touch on. I want to go to the improvement slide. I get questions constantly. And more so now than ever, and I'm not sure why, but I'm getting there, folks. If I'm selling for $10 million, can I buy property for $5 million and make improvements for $5 million and get 100% deferral? Yes and no. You cannot close, take title to that replacement property that you need to improve in Harlem or wherever, and after it make the $5 million of improvements and expect to get credit against your $10 million 1031 requirements. We have to park the replacement property. We have to set up a parking arrangement. And you need to have made improvements that you're going to get credit for, the $5 million worth of improvements, or enough of that to make it worth your while, within a maximum of 180 days from the earlier of the date you sold, the relinquished, or you purchased the replacement. So example, you're closing on your replacement on June 1. If you sell your relinquished property after June 1 in a reverse exchange, you have 180 from June 1 to do your improvements. But if you sold your relinquished property on May 1, and you buy your replacement on June 1, you've lost 31 days of your 180 to make your improvements. You don't have to be CO'd. Whatever you get done, hard and soft costs during the 180 counts, but you certainly don't want to do this and find out you only got $100,000 or $50,000 of improvements made when your aim was $5 million. So planning, working with your contractor, and those kinds of things are very, very critical to the success of an improvement exchange. Another reason I think I should get fewer questions, and I'm getting more questions about improvement exchanges, is that the new Tax Cut and Jobs Act allows write-off, sometimes immediate write-off, of many improvement costs now. So you may not need an improvement exchange as much as you did before the Tax Cut and Jobs Act. So again, I'm going to send you back to your CPA. Final note here, even though ESQ is after my name, I can't give legal or tax advice. So I work as one of the team members with the brokers selling, with your lawyers, your tax advisors, and again, the brokers on the replacement property side. I know this has been a whirlwind presentation on 1031s, but do I have any questions from anybody, burning questions that I can answer? I thank you, Asher. Here you go.